It is Wednesday, the 8th of July, 2020. The S&P 500 did get back above the week-to-date volume-weighted average price after testing the rising 5-day moving average. No surprise that the market bounces with a rising 5-day moving average, and we have this prior band of resistance over here, which is now starting to form some support. So it looks like the next step for this market is to close this gap and then on to new highs for the year, rather, not all-time highs for the S&P 500. But the market remains constructive. The Nasdaq, that pattern of higher highs and higher lows, continues here as well. The market is extended at this point on the Nasdaq. If you look at where we are now versus prior rallies, it kind of looks something like this. It doesn't mean the market will pull back. It means that just be a little bit more cautious about the stocks that you're buying and be sure not to chase. We are still holding above the week-to-date volume-weighted average price here. That's that black line, and of course above the rising 5-day moving average. So the trend remains innocent till proven guilty. Extended and overbought and words like that don't mean it's time to sell or sell short. It means just be a little bit more cautious about what you purchase. The Russell 2000 continues to be the laggard as it's stuck below not only the black week-to-date volume-weighted average price here, but the volume-weighted average price from last week and, of course, the declining 5-day moving average. For this market to get some better upside opportunity in the near term, it's going to have to get above and close above 143. Until it does that, we're just kind of building energy here for a break, really in either direction. It seems a symmetrical triangle typically resolves itself in the direction of the primary trend, and with a rising 50-day moving average, that tells me that the upside is more likely, but we just don't have evidence of that yet. We have a big mess here on the intermediate term time frame, so let's just leave that alone. The semiconductors closed at a new all-time high. This prior resistance, as we had noted, was being hammered away with more repeated tests of resistance in the higher low, and it resolved itself to the upside here. So over to the 30-minute time frame, the key level of what we will look for to become support is that 154 level. Not only is that the volume-weighted average price off of this low, but it is, of course, this prior band of resistance in here. So innocent till proven guilty on those semiconductors and the biotechs as well. I'd mentioned in the midday video to subscribers that you want to raise your stop for a swing at this point or even up to here. So if you did raise it up to here on partial, you were stopped out. But again, the buyers remain in control here. It depends on what time frame you're engaged on. We spoke about this pullback and the ability for it to rally, and that's exactly what it's done. Now the question is, where do you put your stop? If you're still involved in here, which you should be with at least a portion of it, I think, then maybe you raise your stop underneath today's low, because that's the most recent relevant higher low with a rising 5-day moving average. The thorn in the side for the market remains the semiconductors. They closed right at their week-to-date volume-weighted average price. They're not going lower, really. I mean, we're basically even for the week after Monday's gap up, and the 5-day moving average is flattening out, but the daily time frame just still looks ugly here. I think as long as it holds above 2250, it won't pose any danger to the overall market, but breaking below and holding below 2250 could spook this market, and then we could see some more aggressive profit taking.